This is one of those names, Jim, and I remember when we would sometime back at the New York Stock Exchange, you'd wander across it. I'd be like, wait a second, that's a $70 billion market value. Right. By the way, now 82, bigger than Goldman Sachs, is S&P's market value. Why? Well, data and also the willingness of the market to pay a huge multiple for these recurring revenue streams that this data business, obviously they have the ratings business, affords them. And so here's a deal this morning, enormous, roughly $40 billion. It's all stock. 0.2838, of course, is the exchange ratio. It is expected to be accretive to earnings by the second full year. By the way, earnings per share, they seem to care about it, but the people who value this company are doing it on an EBITDA multiple and even maybe a free cash flow multiple. They are talking about this company generating over $5 billion in free cash flow by 2023, and they're going to return over roughly 85% of that to shareholders of that $5 billion that they see in terms of free cash flow. Give you a quick quick sort of timeline. S&P approached them in September, I'm told, and Lance Ugler was like, yeah, let's go. You're the potential partner that I've thought about in the past. And so they started to engage. They started at what was sort of a multiple based on the respective market values for the two companies. Let's call it around 0.21, somewhere in there. And they made it up to 0.2838. That's where you end up. But, of course, they're really trying to figure out as well who owns how much of the combined company. And so they end up there as well in terms of 67.75% of the new company being owned by S&P shareholders and 32.25% by IHS. Again, Jim, it is the multiple here that the market is willing to pay. And the numbers they're talking about, even revenue, they're talking revenue synergies. $680 million in EBITDA. That's by 5 years after close, fully realizing those synergies. But that's huge. You throw the multiple that the company gets right now on a $680 million EBITDA appreciation, and you're adding $15 billion in market value. So let's keep an eye on shares of S&P, of course, which is the full currency here.
Well, I do like the fact that it reduces S&P's ratings business from 47%, which a lot of people feel is pretty static business, to 30%. Doug Peterson has done a series of acquisitions. He bought a company from me. He bought a company from me. I did good. He did good.
Right.
So, I mean, one of the things I know about Doug is he's incredibly even-handed. You know what? I'm so glad that he's on our show tonight.
He's coming on the Big Mad Money program.
Yeah,
Not here, but there. Nice.
Well.
And that's great. By the way, antitrust, we were just talking about it. There's no real overlaps here. So while these reviews do take their time, they're talking about second half of next year, but there doesn't appear to be any overlaps in their business.
None.
Jim, who knew data was such an incredibly lucrative business?
Shepard Smith here. Thanks for watching CNBC on YouTube.